Stuart, Kaiser, you should be positive, and by the way, you should be smiling because you work for Citigroup, and I've seen that stock. So on a personal note, maybe hopefully you had a very, very good year. What do you see for at least maybe not the full year, but the beginning of the new year? What kind of positioning and strategy do you guys have at Citigroup?
Look, I think if there's one thing that maybe does change with the calendar year flipping, it's portfolio managers have a little bit more risk tolerance and a little bit more risk appetite than they would have at the end of last year. You know, there's a lot of folks we talked to in November and December saying that 2025 was such a difficult year. If you were up, the last thing you wanted to do was stub your toe or make a mistake, you know, kind of going into year end. So I would expect, you know, PMs on the institutional side to maybe re-engage a little bit more via, you know, through risk than they were kind of late last year. If you're going to take any positive signal, I think, away from today, and I agree with Karen, it's you have to really squint to, you know, get any signals out of this. I do think, you know, the move in small cap and the move in regional banks is encouraging because, you know, to Bonawit's point, there is a focus on the big, beautiful bill. That is a domestic stimulus, you know, bill basically, and who's going to benefit the most from that? It is smaller cap and regional banks. So,
I love this idea. So, and if shorter Stu Kaiser, I don't want to misquote you to you. The idea being that fund managers, maybe like a Karen Feinerman, they did so well in 25. You get a little cautious or, I don't want to say cowardly, but you want to protect your gains. And then maybe now you can, you've got more room to play at the beginning of a new year.
Yeah, I think that's right. You have a longer investment time frame, number one. And number two, like, given what happened last year, if you manage to fight your way through that year, you know, with a decent return, you know, the last thing you wanted to do was take any chances. So our kind of view into year end was you would rally, but it's what had worked in the beginning of the year was what's going to work into year end because we didn't expect people to get all that creative. A lot of PMs I talked to did not want to hear our creative ideas, right? It was much more a discussion of, hey, what's going on with this AI trade? Hey, what's going on with retail trading? It wasn't, hey, do you have any new idea I haven't heard of yet? And I'm going to put that on for the last 2 or 3 weeks of the trading year.
So let me ask you a question. In terms of flow of funds into the market, is that generally even all year where you see a higher amount of money coming in at the beginning of the year? You said the bonus part, but I mean more broadly than that. Is there something that would make the beginning of the year just structurally a time where more money has to go to work and therefore stock prices would likely go up?
Honestly, I think the biggest flow you see at the beginning of the year tends to be a rotation out of winners and into laggards, right? You're kind of that,
out of winter, tax selling after the new year, okay.
And what are the dogs of the Dow, type situation. I've got to buy what's lagged. Then you get tax day. So I agree. I think bonus season matters. I think tax day matters, and I'm sure we'll get into it later. The big beautiful bill and the potential tax refunds is an enormous story. So I think you have a little bit extra risk tolerance. I do think you have people that are willing to play around in some of the laggards, and then when we do get bonuses, later this month or early February, that might help a little bit incrementally.
Stu, in your opinion, is that a reason to kind of look at the trends early in the year and try to extrapolate what might happen over the course of the year? Or is that more reason for you to perhaps fade some of the things that are happening earlier on the year because they tend to be one-off? As you mentioned, you're willing to take a little bit more risk on the dogs of the Dow type of trade. Because, yes, you have much more time and you have, law of large numbers. But at the same time, there could be a recency bias to that may not necessarily play out because I doubt that most people are going to elect to buy losers and add to losing positions over the course of the year. So how should we be looking at that trade?
Yeah, I mean, if you think of like the momentum rotation or something like that, that tends to be quite short-lived. It's the first 2 or 3 weeks of the year, and then it kind of calms down. Another way to think about that might be Europe the last few years. Typically, you've had Europe rally really strong in January, and then once the initial people buy that, that trend kind of fades. So I wouldn't necessarily, think of the early year being all that indicative of what happens the full year, unless there's a meaningful change to your investment thesis. Like as you mentioned, the calendar year changes; it doesn't change your base case. So,
but okay. I know we got to get Steve Leachman, but I will say that what does change on January 1st are the tax laws.
Yes.
And that may influence the way people invest because small caps benefit from more people getting tax refunds. So maybe something actually does change on the calendar.
This year, look, you've had a meaningful change in the underlying policy backdrop. And if you believe that is, has legs to it, yeah, we do think there is a trade there, and we'll get into it later. I mean, we believe people are going to take a shot at this cyclical trade early this year. They're going to be very sensitive to tax data in early February, but we do think it's a real thing.
Okay.